Hi everyone, this is Michael Bengiat with Lifetime Investor, and this is the end of the year market trend advisory weekend review video for December 31st, 2022. Let's go ahead and just get started. Here's our disclaimer. So what I want to do in this one, we're going to talk about, as usual, the market trend summary and what's gone on this year, and then kind of some lessons to be learned from 2022, which was a difficult year for almost everybody. So we'll get to that at the end. So we've ended the year here with the market back in a correction. We have no exposure. The market count went to zero. Even with the individual stocks on the NASDAQ, we've turned that down to no exposure because they're just really acting very poorly. For the S&P, all the same, except for the individual stocks are giving us a little bit more, holding up a little bit better for those kind of stocks that are in the S&P, more the cyclicals and the energy stocks. So we've given just a tiny bit of exposure, but otherwise we're just all at zero. The power trend is off. It's just, unfortunately, that's how this year started off in a bear market, and we've ended in a bear market. But lots of lessons to learn in there. In terms of our investing strategies, we did beat using our market count 1x, which is no leverage. And this is, again, we're always comparing against just buying and holding the QQQ and the SPY. So we've ended up just about almost twice as a better return as the QQQ, which went down 33%. We went down 17.75 on ours. And then for the SPY, it was pretty close, but we ended up still beating SPY buy and hold. Now, here's a look at just all of their strategies that we have. We actually have our 1x, which is just non-leveraged, and 2x is leveraged, and then 3x is 3 times leverage. That's using the TQQQ. And then SPY, we just have 1 and 2. Now, you can see here, using any kind of leverage, you just really ended up with poor returns. And one thing we're actually, unfortunately, we weren't able to get finished by the end of the year is we're coming out with a new composite strategy that allows you to be able to use the leveraged ones in conjunction with going in unleveraged. So that's going to be coming out really shortly, probably within the next 2 weeks. And then we'll kind of just do that to the beginning of the year. And then we'll be sort of using that, and we'll add it to our investing strategies here too, so you can see all the results. But one of the lessons here is that you just couldn't, in a bear market, you're a lot of times you're just really not trying to make a lot of money. You're trying not to lose a lot of money, and using any kind of leverage just amplified the returns to the downside. Here you can see we're down 47% if you had been using the TQQQ, even with our strategies, which are getting you in and out of the market. And avoiding most of the downside, but still, just using that kind of a triple leverage just gets you into trouble. So that's one of the lessons here is that, the bear market, get off leverage, get off margin, and then, using our system, you're trying to then just determine how much should you be invested. For much of the year, it was zero or very little. Especially, let me go back to this chart here. For individual stocks and non-index ETFs, I think just for a couple days, we went up to 50% exposure, and that's during the whole year. Most of the time it was at 25 or under, and a lot of time it was at 0. So really there's a lot that goes into this indicator here, the signal, in terms of what's happening with stocks under the surface, not just the indexes or the mega caps, which tend to just give you what the indexes are doing. So this would have kept you out of a lot of trouble just following this in terms of not getting heavily invested during this market. And it's tricky. Bear markets are very tricky. You get these huge up days, short covering rallies. The market's always looking like it's going to bottom. People don't want to miss out. Like they're going to miss out a couple days, and that's all the return for the year. A lot of FOMO, fear of missing out comes in. So, we're always trying to eliminate emotions out of investing. And by sort of following our signals here, would have kept you out for most of the damage and just, turned a bad year for the indexes into, a minor loss. In our stock pick service, we actually just went down, I think 5.15%, which was, very recoverable. Obviously, we don't like having a down year, but very, when the market turns around and we have a good period, that 5% comes back very quickly. And the important thing is we didn't dig ourselves into a hole. Now, our long-term outperformer portfolio, which we also track, we actually ended up positive for the year, and mostly because we had very few trades because nothing was set up. And there's another lesson there. We'll talk about that. Well, I might as well just say it here. And you don't trade if there's nothing to trade. We don't bottom fish in our system. We're always looking for the best stocks that are breaking out, high relative strength, the leaders. We want the leaders. We don't want the beaten down former leaders, like all these tech stocks, Apple and Tesla and all that. So by the fact that we didn't trade much at all, we ended up with a positive return in a year where the NASDAQ went down, I think, 34%. Okay, let's take a quick look at the indexes. The Dow ended up, I don't have the stats here, they're coming up in a little bit, but it was the strongest index. I think it was down 8.8, something like that. It's still negative for the year, but beat all the other indexes. You can see it's holding up above its 200-day. That's the black line. Getting resistance now at the 50-day, which is the red line, but it had blasted past all of these for a while. And kind of, I talked about this over the year, kind of unfounded enthusiasm and optimism that the bottom was in and the Fed was basically going to cave and we were going to get interest rate cuts coming in 2030. I mean, none of that it was all wishful thinking. I mean, it never was any data from the market or Fed Chair Powell or anyone that this was actually going to be the case. Probably a lot of short covering in there too going on, and this is what makes these bear markets very, very tricky to navigate, because you get these huge moves that come out of nowhere, and of course everyone starts saying that's it, the bear market's over. But we're not over yet. But the Dow did the best of all of them. S&P was next. Again, I don't have the stats right up so hold on a second. Let me go back down here. Here's the stats. We'll come back to this. Minus 8.78 for the Dow, minus 19.44 for the S&P, minus 33.1 for the NASDAQ, and 21.56 for the Russell. So basically, bear market statistics right there. So the S&P holding up a little bit better, but we're down below the 50-day and the 200 and the 21-day. Just technically, it's not a strong picture. Would not be surprised to see new lows. But the market's trying to sort of hold here and holds this area. But anything can happen, of course, but I wouldn't be surprised to see that go lower. Also because the NASDAQ is really, really the weakest and is very, very close to breaking two new bear market lows, which was at 10,088. So we came very close, but we've kind of bounced again. But, we're having low trading volume end of the year. So it'll be more telling when we see what happens the first week of January, when, the most players are back in business and the institutions, we'll see what they're going to be doing. And then finally, the Russell, sort of in between the S&P and NASDAQ, also acting pretty weak, but not as close to the lows. But all in all, this is a bear market. We're in a downtrend. Look, you can see the 200s rolling down, starting to flatten out a little bit. But I mean, look, this is downtrend. It's all heading down. And that's why we're in a market in a downtrend and we're in a correction. And it's actually worsened. So just quickly in the technicals, just not getting any kind of sense of strength. 52-week lows outpacing 52-week highs. We only have less than 40% of stocks above the 200-day. This is all weak. Look across here, it's weak. The number of growth stocks that have held up breakouts is down to 3. That's almost the lowest I've seen. Not long ago, it was like in the 90s. So really, this just deteriorated in the last 6 weeks, really, really badly. Down volume is mostly swamping up volume. You can see here in the color codings when it goes into the red. And so not a good picture from the technicals. And then as we continue lower, we're just sort of neutral and even a little bit bullish at times in terms of the market. I'm sorry, this is, this should say market. This is sentiment. So let me just fix that. Oops. Okay, on the fly correction. There we go. So this will probably, I think, by the time we get to a true bottom, is going to be a black again, like we saw it at previous times. We are getting shows of strength. We had a day here when 1.61 on the put call. Normally above 1.15 or so, you're starting to get that fear coming in, but it just didn't last. Shot straight back down. The VIX has just been, one of the things is this has been solid red all year. It's just showing that volatility is just high, and that's not a trader's friend. We don't want to see this high. This needs to come down and start giving us some green. And I think when the market finally bottoms out, you're going to see a change across all these. That's what we're looking for, is the market just needs to have a change of character. And we're just not seeing that. We see little glimpses of it. At times we see things kind of getting more bullish, and the greed came back in here, and it just doesn't last. So it's a process. So we're going to be watching out for that. Okay, so just recapping, yes, we all know it was a challenging year. It was really the worst year since the 2008 financial crisis. Basically, everything got hit: stocks, bonds, gold, crypto. Now we have real estate is starting to decline in prices. So really, it's these markets can hit everything, and which unfortunately makes people feel a lot poorer, because there's nowhere to hide. And the bond market, this is one of those things that people say, well, we invest in bonds, supposed to offset the stocks. You have those traditional 60-40 portfolios. It just didn't work this year either, and the bond market had its worst year since 1976. So that was our year. It was an ugly one. So overall, we had the main themes were inflation. We had tighter monetary policy. We had the war, of course, and then we have probably more going into declining earnings. They've sort of held up, but there's a lot of warnings about going forward. And these are all going to be probably factors in 2023, certainly for the first half of the year. And of course, not listed here is that are we going to go into a recession? So let me add that too. So that's the other big side. Are we going to go into a recession? Likely. A lot of indicators are already pointing towards that. So probably the more the question is it going to be a short, shallow recession, or is it going to be a more extended one? If we don't go into a recession, the market basically has fallen. If you look at the S&P, about as much as it usually has fallen in non-recessionary bear markets. But if we go into a recession, we may have farther to go. I think the average is more like 35 to 37% down for the S&P. So we don't know what's going to happen there. And then finally, we still have a lot of volatility. That's going to continue as the market kind of fights what's going on. And then one thing we'll be looking for is that, history tells us that markets will rebound before the recovery in the real economy. And you'll see that. It'll probably happen at some point. The Fed will pause its rate hikes, and the market will probably, depending on other things, of course, but historically, you'll see the market starts to go up during the pause, and not when it's actually well before the Fed actually says we're going to be actually cutting interest rates, which has been usually the policy. They'll hike, they'll pause, and then if they can, they'll cut. And the market usually bottoms out well before that. And by the time it hits the rate cuts, it's actually already booming ahead in terms of the stock market, because it's always looking ahead of what's happening in the economy and business. So I just want to go through a few lessons here. I'll try to keep this pretty quick. But the main lesson here is all stocks are risky. And it doesn't matter what they are. People have unfortunately learned this. There was that belief in the FANG stocks, Facebook is now Meta, so maybe it's the MANG stocks. But you had, Apple and Amazon and Netflix and Google and, all of them. Tesla, they can't go down. They're just institutional quality. They're just, they have their moats around their business. Well, it's all bunk. I mean, you can go back in time and look at, all the stocks that have always been, there's always that sector of kind of the immune stocks. There was the Nifty 50 back in the 50s and 60s. They were all determined you buy and hold forever. Well, many of them went bankrupt. Most of them went down 50, 60, 70 and more percent. And that's where we are now. I mean, a year ago, no one would have believed me if I'd said, Amazon is going to go down 50%. Tesla would be down 70%. Apple would be down in bear market territory. There was never that belief. So that, all stocks are risky and all of them can go down. And there's actually a saying that, many stocks will go down, 50% of stocks will end up going down 80% when they peak. And 80% of stocks will go down 50%. And that's the leaders. So anything can happen. So that's one of the lessons that, you have to not believe that you're going to be holding these things forever, especially if you have really large gains after many years. At some point, they need to be sold and the gains need to be locked in. And a lot of people, unfortunately, learned the hard lesson this year that, those gains can evaporate, pretty quickly. I mean, Tesla alone in December went down about 40%. I mean, that's just unheard of. But that's what can happen. Let's go back to this first one here. So we have the second one. We have the bottom fishing. So I wanted to show, the poster child of bottom fishing is, Cathie Wood from the ARK funds. Now, this was the star performer in 2020. Huge gains. But look what's happened. We completely erased the whole move in 2021. The fund is down 81% from all-time high. It's down 63% since the beginning of in 52 weeks. I don't even know. My money's still coming into this fund. I can't imagine why. It's like a cult. It's a cult of personality. The people just believe in her like Elon Musk. They can do no wrong. But if you're an investor, for most investors, you've lost a lot of money. And she continued. In fact, I just saw in the news, she was buying Tesla and DocuSign and Zoom and a bunch of other stocks that are down, 80%, 70%, some cases 90%, and she's still buying them. This is the road to ruin. She is down, I think she's down on almost all of her positions, like huge, 50, 60, 70%. For any of us individual investors, you're done. You've lost all your money. But of course, she's just running other people's money. So obviously, in some ways, she cares, but in other ways, she's not her money. So she's just gambling with it. So there's no sense of risk control or anything on her purchases. Why would she? She's never been holding a stock down 90% and then buying more on every dip. And so she's accumulating a gigantic position in stocks that some of them are going to go under. And you can even see, just because you look at their fundamentals, you'll see a lot of them are just losing money like crazy. And in this kind of environment where interest rates are going up, some of them are not going to make it. So that's the big lesson right there. Don't bottom fish. Where is the bottom? This is just looking at a lot of these big high-flying stocks. Well, it looked like this was the bottom. So you bought that. Oh, yeah, I was smart. Look, I got this huge move. And then, bam. So you buy this one. No, that's not the bottom. You buy, okay, it looked like it bottomed here. We had a nice reverse hammer here. Came up. No, that wasn't the bottom. Oh, look at this one. Powerful. Big move off the bottom. Nope, that wasn't it. No, huge move off the bottom here. That's got to be the bottom. Nope. Then we had a really big decline. Another big reverse hammer. All these hammers are showing that the buyers are just coming in on the dip and buying and buying and buying and buying, pushing it all the way back up. And then here we are, back down. And look, we had another little one, just below 30 with the stock, and the buyers are just still coming back in. Look how many times this has happened. Look at the moving averages. This is a monthly chart. This is just, if you're asking to lose money, this is how you do it. You buy these stocks that are going down. So there is a big lesson there. You can't be bottom fishing. No one knows where the bottom is. The bottom can be $5 for ARK, for all I know. It could be zero. It could go out of effect. It gets to the point sometimes with these funds, there's so many redemptions, then she's forced to sell, and this just keeps plunging and plunging, and they go out of business, and then you end up with nothing. So that's a very difficult. So you have to be. You don't want to be buying the bottom fishing these stocks because they're in downtrends. You're just asking for trouble. So you're buying a falling knife, you get cut up. That's the lesson there. The big one, I think, for a lot of people is you don't heed or you don't know the sell signals. And I want to just kind of show you a couple charts of Tesla, because this has been the big poster child. So here we have in 2020, I want to point out some of the sell signals that were developing in the stock. And there were a bunch. But in 2020, we started to go on what turned out to be just the final massive run. This was in August, and this ran up. I'll show you the next slide too. So, but you had a bunch of climax runs, and these are sell signals. And if you don't know what they are, then you miss out. So here we had, I wrote previous here because I'm talking about this is the later one. So we had here, we start gapping up. We have the biggest days, up days in a row. We have so many up days in a row here. And so we had this big move, 273 to 502. And of course, they're not sustainable. You can see the angle here, how sharp it was. Where here you can see the angle was just kind of going up, and then it got really sharp in a big move. That's, you sell into these climax runs. And there's other rules there I can't talk about here. Then of course we corrected, we were very swiftly, almost came back the whole move, formed a little almost like a little triangle here. And then we broke out again and went for a second climax run, 11 days up in a row at the end here, 100% gained in 7 weeks. We were 130% above the 200-day. So here we have here the biggest up days, gappings, exhaustion gaps going on, gap. These are classic signs of the stock overheating, and that's the blow off top. You sell into these. Now this turned out not to be the final climax run. There's very few stocks have done this, and this is usually they become kind of the cult stocks. The big one was Axon, which is Axon now. It was Taser at the time. They have those the tasers, and then they turned into doing body cams and stuff, which is what they do today. And that went on I think 3 or 4 climax runs, just equally powerful until it finally topped out. So then here's that run we just saw from the previous one. Then the stock corrected a lot. So again, even if you were still holding it, you had to sit through these. This was 900 to 530. That's probably a good 40% decline. Then it kind of calmed down again, and then really got tight. Nice buy signal right here where it got really tight. And then we went on the final blow off. Again, we started gapping up the biggest one-day moves. We had another gap here, another gap here, and then we finally formed these 2 little island tops. These are all sell signals. Then we had the biggest down day on huge volume. So we were starting to get this added up. You have a lot of sell signals going on here. This was the final top of Tesla, and now we're down 70% from that high. Now, of course, these stocks don't go down usually don't just crash down and keep going. Of course, you have these big rallies that fake people out. Again, gap, another little island, and then it just plunged, and then it just never really was able to come back. So that's why they fool you. But when you see the signs, you have to sell into these, because those, especially after a third one of these, that's really, if you were still in the stock. But more if you're more of a trader, even a longer term, this was one to sell into. You sit this out, and then you finally got another buy. You could have bought here right before the big run, and just in a couple of weeks, you would have made really a pretty nice move. This is 38% from the top of here. This is probably almost like a 45% move in just a couple of weeks. Time to say goodbye. So those are not knowing the rules and not heeding them is even worse. And I can tell you, every single stock that's gone down from the top, and some of them are down 90%, they all had all sorts of different sell rules, sell signals that were going off there. So I just wanted to say here, we do have a selling stocks mastery course. I put it together last year, in the middle of last year. I just want to say here, if you're interested, you can get a special $100 savings. It's normally $197, so you can, with using this coupon code 2023 New Year, you can get it for $97. It's 5 hours of instruction. There's 29 videos. Really goes into all the sell signals, whether or not you're a long-term trader or if you're a shorter-term swing trader. I highly recommend it if this is something that you just missed, and you've ended up writing your profits down to, in some cases, hopefully not to negative, and now you have losing positions, but you ended up not getting out with, when you had big profits. So I highly recommend that. It's probably most people in the stock market, this is the weakest part, not knowing the sell signals. And of course, part of that, we go into stops. And one of the reasons why you avoid having these giant down days, or drawdowns, is not using any kind of stops or risk control. Kathy Wood is the poster child of that. If you do the opposite of what she does, you would do much, much better than she does. And so that of course, we talk about how to use stops and the best way to do that in this course too. But I'd say that's the final thing. Even if you don't know much about it or you don't want to learn, just something as simple as a stock goes down 7 to 8% from your buy, you just get out. Doesn't matter what the reason is. You forget about ego. It doesn't matter if you were wrong. You just, the first loss is the best loss. And one of the reasons if you're down only 7 to 8%, you only need like a 7.5 to 8.25% gain to get back to even on the next trade, which is totally doable. I mean, almost all stocks will go up 10% or so at some point. The more you go down, if you go down 50%, you need a 100% winner to come back. Much harder to come across. So, so these are the lessons. I'd say that's to wrap it up. For 2023, keep all these in mind, and we're all trying to do better. We always learn, we're all going to make mistakes. Even the best traders, or even the long-term investors like Warren Buffett, he's the first to say in his annual reports that, he'll say, look, I made a big mistake. I bought this stock and I lost $5 billion on it, because he's dealing with, of course, giant numbers, and he'll apologize. He said, I messed up, and even he messes up. No one can know everything, and things just change. So, but I think if you start using some of these and just avoiding some of the most egregious issues, especially not having stops, letting profits dwindle, the belief that all stocks they're just stocks you buy and hold forever. They all need to be sold at some point. And I have my share of stocks too. Early on, I just wrote them up and wrote them all the way back down. And just later on went, what did I do? Why did I do that? And so that's how you learn. So I'm going to wrap it up to here. We're almost at a half hour, but I'm feeling 2023 is going to be a better year. It might come in the latter half of the year, but we're probably going to see just more downside early on. But, I'd say just stay engaged, watch our signals, even if you're not trading, because, we will start seeing the subtle shift in the internals and the sentiment and everything when the market changes. And that's what we're looking for. We want the big changes to start showing up. And they will. We will get at some point a fantastic buying opportunity and bull market. Nobody just knows when it's going to happen. So it could be starting, next week. It could start in next year. It could be in a few months. Nobody knows. But all we know is that we want to be ready when that time comes, because there's going to be really quick money to be made, and that's going to be lasting for quite a while, I have a feeling. So anyways, that's it for this week. I hope you have a great long holiday weekend. Again, Happy New Year, and we'll be back next weekend. Okay, thanks a lot.